Okay, hello and welcome to this module 4 of the price ladder course, where in this specific module, we're going to be going through what we call large orders on the price ladder. And specifically, what do I mean when I say large orders? So if we just take a look over at the price ladder that we have in the right side of our screen here, and just take a look at the structure of the market. Now, obviously, we've got this market just paused for you guys. I'm going to take a look at each price, what the bids and offers are. So let's just start from the offer side. At 35.79, we've got 1,100. 35.78, we've got 1,000. 35.77, 1.4. Then we've got 1.5, 1.5, 1.4, 1.3, 1.5, about 900, and then 750. Moving on the bid size from down to up, we've got 1,000, 1.6, 1, 1.1, 1.2, and then wait a second. Looking at the price of 35.65, the bid is a lot bigger than the rest of the bids and offers on the book. Even above that, we've got 1.9, 1.3, 900, and about 500 lots. But this bid right here stands out. So basically, what we want to be going through in this module is actually looking how we can interact and trade off of large orders on the order book on the price ladder. Now, what exactly is the strategy, or what exactly is it that we're looking to learn from this, and how are we going to trade this? Well, the specific strategy is called front running. So the specific strategy is called front running. Now, for those of you that have been in the business, you've probably heard of this term before. It does have a very negative connotation. The strict definition of front running is actually an illegal practice done by brokers, whereby they have an order of a client and they buy before they execute the client's order. So if, for example, and we're just looking at the illegal practice, if, for example, we have a broker, he has example there as a Euro stocks, he's got 4,000 Euro stocks, 50 to buy. Before he puts that order on the book, he's already buying. So he'll buy before he actually puts it on the book, and he knows that this order is going to be able to make him profit. I mean, it's a very lucrative business model, but unfortunately it's illegal to do. Now, if we look at, purely the legal practice, is if we see it already on the book. So if I have this order book just the same way anyone else does, and I can see someone with large size on the order book, I could take advantage of that, because essentially, if you can locate that large order, that large limit order in the order book, you can buy and sell in front of them. So as a legal practice, what we're looking for is to buy, sell in front of large orders. That's effectively what our strategy is and what we're looking to do. It's very simple. I mean, it's a simple enough strategy. And how we get these large orders on the book is usually, we usually get these large orders. These large orders are usually a function, or usually a result of bad broking. Now, what do I mean by bad broking? It's just brokers, either bad brokers or bad execution traders, they get given a mandate, say, okay, I want to buy at this level at 35.65, for example. Instead of feeding it into the market, and if you've gone through module 3, you'll know that big orders can be sliced up, and that's what we look for in the order book. Absorption, that's more advanced execution. And I'm happy if you've gone through module 3 and understand that concept. This is very easy for you to understand in module 4, because if you've got a big order, and the guy is just willing to put it out and show his hand at market, you can take advantage of that as a trader. Now, as we said before, trading is very much like poker, and in that respect, it's of the utmost importance to never reveal your hand. Because if you show the other people your hand, the other traders in the market your hand, they will take advantage of that. If I know, and I think I've said this before, if I know a trader in the market has pocket aces, I'm not going to trade against him. I'll trade with him. Obviously, you can't trade with someone in poker, but you know, you're not going to start bluffing and raising the stakes when someone's got a great hand. On the contrary, if you know someone's got a bad hand, again, you're going to play against him big time. So, for example, if someone's got a losing position and needs to get out of the market, and you can see him aggressively trying to get out, trying to get filled, people make those players pay. So that is the kind of the analogy. So just before we close this off, this first part of module 4, I want to just give you guys a bit of an analogy, so just so you guys can picture it in your head. So, for example, um, if we had a room, a hypothetical room, and this room had a ceiling, just like every other room, and a floor. We just built this room from scratch here. So this is our room. We've got our ceiling here, and to the downside, we have our floor. The ladder effectively is acting as a way for, let's say, a person or a group of people to move between the floor and the ceiling. The ceiling and the floor are the main levels in the market the market's paying attention to. So if the market's paying attention to, for example, in this case, 35, it's paying attention to very closely 35.65, as you can see in here, that level in there. Someone's come in and built a very strong floor there with a lot of size. So in that case, if we just had a ladder here just to represent, just draw a ladder between the ceiling and the floor. And there's obviously, some imaginary person. Let's not complicate it too much. Let's say just one person in the room, and that one person wants to get out of this room. Hypothetically, if I told him, okay, mate, you want to get through this, you want to get out of this room, but I told you that the floor had a steel lining. So if I told this hypothetical person, okay, listen, buddy, you want to get out of this room, but I'm telling you right now, if you want to get through that floor, there's steel lining to get through it. That person's probably not going to try and get through the steel floor. He'll try and get through the ceiling. So that's the kind of analogy that I try and give, or I'll try and give, which I kind of thought of 10, 20 minutes ago, but it makes sense to me. Just some way for some of you guys that are really learning this for the first time, for some of you guys that have seen this before and understand it, and you're looking for, a little bit more complex stuff. We'll look at that a little bit later, but you know, for the newbie, the beginner, just to kind of visualize this in your head. The market can move between a floor and a ceiling, and these floors and ceilings are basically, levels. We've got level 2, and this is level 1. But get between level 1 and level 2, the market uses the ladder to move between each level. When it reaches a strong level, i.e. the floor, and the floor is made out of strong steel, i.e. there's a lot of size on the book, usually this guy will come, maybe test it, he wants to see if it's real. He wants to see if the floor is actually made out of steel. He'll come, give the floor a kick. If he realizes that, that floor is strong and it's really that strong, he'll just start climbing up the ladder again. And that's usually what you'll see in the market. And hopefully I'll try and show you guys in the coming videos the interaction off of these order books. They don't always work, but you'll see more often than not, if there's large size on the order book, the market tends to move away from it. On Not always, sometimes it goes through it, but we'll see the examples of where it actually does and where it doesn't. Okay, that's a 10-minute quick introductory video for this. We'll move on to how to actually determine what a large market order is in the next part of this segment or this module. Sorry. Thank you very much for listening.